One of the greatest perks of being self-employed, one of the greatest perks of being self-employed is that you have the ability to dictate how much income you report, and which essentially affects how much taxes you pay. Now, one of the greatest downfalls of being self-employed is that people claim entirely too many write-offs and leave themselves broke at the end of the year. Therefore, in the eyes of the IRS and obviously the banks, they don't make enough income to qualify for a mortgage. You'd be surprised how many people I run into. They make 200-300 grand a year, but on paper, they make 30-40-50 grand a year. And essentially, somebody that makes 350-400 grand a year doesn't want to buy a $200,000 house. They usually want to buy somewhere in the vicinity of a $700 to $1 million house. Now, how do we get around this? Bank statement programs. If you don't want to claim the income on your tax returns and you don't want to pay the taxes to the IRS, the simple, most effective solution is bank statement programs. What is a bank statement program? The bank or us, we will actually use 12 to 24 months of your bank statements. We would receive your bank statements. We would calculate every single deposit that you get to your business, remove any self-transfers or loans that come into the business account. We take that number, and the rule of thumb essentially is that we use 50% of your deposits, right? 50% of your deposits. Therefore, we give you a 50% expense ratio. If you had $1 million in deposits, let's say in 2022, we would deduct that by 50% and give you a $500,000 income for the year. Now, essentially, if you have a lower income, and we need to maximize how much buying power you have, we can do a CPA letter and change that 50% expense ratio to a 25% expense ratio in order to give you more qualifying income and help you get the house that you want to get. I mean, is it worth it? I think it's worth it. I mean, what I tell people all the time, the majority of the time, is, if you have to go claim $200,000 in income this year in order to have the qualifying income to buy the house you want, essentially your tax liability is going to be somewhere in the vicinity of like $50,000 to $75,000. Why not take that $50,000 to $75,000, put your 15-20% down on a home, and I mean, essentially, it's going into the equity of the property, and you're not just giving it to the IRS. This is a solution that you might want to consider. Why don't you call me or one of my associates today, and we can get you moving in the right direction.